Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Sounds good.
So I want you to imagine you're in this bustling open-air market in Southeast Asia. Or maybe you're stopping by a small street vendor in South America
Okay, I'm picturing it.
and you want to buy something.
Oh,
But the shopkeeper, they don't want your local currency. And weirdly enough, they don't want physical US dollar bills either.
right, which used to be the gold standard for traveling.
Exactly. But instead, they want US dollars sent from your smartphone directly to theirs, instantly, and without a single traditional bank being involved in the transaction.
Yeah, that is the new reality we're looking at.
It really is. Today, our deep dive is looking at this stealth invasion of the digital dollar. Because according to recent analysis, there is a massive, very quiet war happening right now over the actual plumbing of the global financial system.
And the weapons in this war aren't missiles. They aren't trade tariffs. They are something called stablecoins.
Right. And I want to be clear right up front for everyone listening, we are not talking about wild crypto speculation today. We're not talking about day trading some meme coin to get rich quick.
No, not at all. To really grasp the scale of what's happening, we have to move completely past that traditional view of cryptocurrency.
Right, because most people hear crypto and they just think of Bitcoin, swinging wildly in value.
Exactly. And a stablecoin operates on completely different logic. It's a digital token that lives on a blockchain, but its value is anchored to a real-world asset.
Anchored meaning it doesn't fluctuate.
Right. And in almost every major case, that asset is the US dollar. So one of these digital tokens is designed to always equal exactly $1.
Period. No crashing by 20% overnight.
Right. And what we are seeing in the data is that this specific invention, the digital dollar, is fundamentally rewriting how money moves across borders. And it is sending major economic powers, like Europe, Japan, the UK, into this frantic defensive scramble to protect their own currencies.
It really is wild. But before we get into how other countries are trying to build these high-tech digital moats to keep the dollar out, we need to establish just how dominant this digital dollar has actually become.
Oh, the volume is staggering.
Yeah, I was looking at the data from a June 2026 Zodia Markets report, and they looked at transaction volume for their clients in the previous year, so 2025. The dollar-based stablecoin transactions hit $110.5 billion.
That is billion with a B.
Right. And for context on that dominance, let's look at the competition.
Yeah, the contrast is crazy. In that same time frame, stablecoins tied to the Turkish lira sat at around $3.4 billion.
Okay. And what about the euro? You'd think the euro would be massive.
You would think so, but
Yeah.
the euro was barely registering. It was sitting only in the tens of millions.
Tens of millions. Wow.
Yeah. The global digital currency market is practically a monopoly at this point, and it belongs completely to the US dollar.
Okay, I understand the numbers, but I have to push back a little on the user behavior here.
Yeah.
Let's look at this from a beginner's perspective.
Sure.
If someone in an emerging market has a smartphone and wants to use digital currency, why not use something decentralized? Why are everyday people choosing a digital version of a fiat currency that's controlled by the US government?
Well, it really comes down to utility versus speculation. In a lot of emerging markets, people aren't looking for an asset that might double in value, but could also, crash by 50% while they sleep.
Right, they just want safety.
Exactly. They are looking for a life raft. If you live in a country dealing with soaring inflation, your local currency is actively losing purchasing power every single week.
Buying groceries gets harder every day.
Right. And on top of that, your local banking system might be unreliable, or maybe you're an expatriate worker trying to send money back home to your family.
Oh, let's actually dig into the mechanics of that. Because the way we send money now is surprisingly clunky, isn't it?
Clunky is an understatement.
If I want to wire money internationally through a traditional bank, I'm dealing with the SWIFT system, which means my bank sends a message to an intermediary bank, which sends it to another correspondent bank.
It eventually gets to the destination.
Right, and it usually happens in these overnight batches. It takes days to clear, and everybody takes a fee along the way.
That is the perfect contrast right there. The traditional banking rail is essentially just a series of physical databases talking to each other through middlemen.
Right.
But a stablecoin transaction happens on a public blockchain ledger. It is entirely peer-to-peer.
So no middlemen.
None. When you send a dollar stablecoin, like USDC or USDT, to someone in another country, it arrives in seconds, and the fee is often just a fraction of a cent.
That's incredible.
Yeah. There are no correspondent banks. There are no weekend closures. It is available 24/7.
Wow.
So for a worker sending remittances home or a shopkeeper wanting to hold a stable store of value, stablecoins are just a frictionless alternative to the legacy system.
It's essentially like a digital mattress to stuff your dollars under. But instead of taking up space in your bedroom, the mattress is just an app on your smartphone.
That's a great analogy. And that digital mattress is entirely insulated from the economic turmoil of their home country.
Okay, so if a massive portion of the global population is bypassing their local banks and just downloading US dollars to their phones, what happens to the local central banks? Because I have to imagine they are terrified.
Terrified is the exact right word. And it brings us to a concept called monetary sovereignty.
Okay, what does that mean?
Well, according to recent analysis, on June 1st, 2026, Isabel Schnabel, she's an executive board member of the European Central Bank, she issued this stark warning. She stated that the surge in dollar stablecoins actively strengthens U.S. dollar dominance while weakening the euro.
Let's break down why that happens mechanically for our listeners.
Yeah.
Because the central bank's main job is to steer the economy, right? If inflation is too high, they raise interest rates to cool things down. If the economy is sluggish, they lower rates to encourage borrowing and spending.
Exactly.
But that only works if the citizens are actually using the local currency.
And that is the core vulnerability. If European citizens and businesses start conducting their daily trade, their cross-border transfers, and their digital savings using a US dollar stablecoin network, the European Central Bank literally loses its steering wheel.
Oh, wow. So changing the interest rate on the euro just doesn't matter if everyone is holding digital dollars instead.
Exactly. And on top of that, European commercial banks lose their direct relationships with customers. They lose all that transaction data. And data is the lifeblood of modern banking.
Which perfectly explains the massive countermaneuver we're seeing from Europe right now.
Yeah, they are fighting back.
Because recent data shows European banks are not just complaining to regulators, they're actively building a defense system.
Right, the Qivalis project.
Yeah. Starting in late 2025, a group of major European banks formed a consortium called Qivalis. And their entire goal is to launch a highly regulated bank-backed euro stablecoin targeted for late 2026.
And the scale of this is huge.
It is. It started with 12 massive players, like BNP Paribas, ING, and UniCredit. And by May of 2026, it had expanded to 25 banks.
The sheer size of that consortium is a direct reflection of how big of a threat they perceive this to be. They recognize that if they don't provide a digital, blockchain-based euro, their customers are just going to default to the frictionless alternative, which is the digital dollar.
Okay, wait. I have to play devil's advocate here for a second.
Go for it.
A consortium of 25 massive legacy European banks. I mean, that sounds like a bureaucratic nightmare.
It definitely could be.
We are talking about institutions that are notoriously slow to innovate. Aren't they like a decade too late to fight off these nimble, heavily funded tech companies?
That's a fair point.
Like, why would an everyday user switch to a clunky bank coin when dollar stablecoins are already seamlessly integrated into every major exchange and digital wallet?
It's a very valid skepticism, and honestly, the banks themselves are aware of that friction. But Qivalis isn't trying to outmarket crypto startups to retail day traders.
Okay, so who are they targeting?
Their target is institutional trust and regulatory compliance. The legacy banks have something the tech startups simply don't have. They have existing trillions in corporate deposits, they have deep integration with national clearing systems, and they have the implicit backing of the state.
Ah, I see.
So they are betting that major corporations and conservative financial institutions will prefer a digital euro issued by a highly regulated bank they already use, rather than some token issued by an offshore tech company.
So it's not about having the coolest app. It is a pure survival play to ensure the euro remains relevant in a digital-first global economy.
Exactly.
So if Europe is frantically building this high-tech digital moat to keep the dollar out, is this an isolated reaction? Or are we seeing a global panic?
Oh, it is a global chain reaction. Just look at Japan.
What's happening there?
On June 1st, 2026, a ruling party panel urged the Japanese government to actively promote yen-based stablecoins specifically for Asian regional payments.
They want to protect their turf.
Exactly. They don't want the yen squeezed out of their own hemisphere, and they aren't just talking about it. Their top three banks are already building projects with the full support of the government's financial services agency.
Wow. And what about the UK? Because London has historically been this massive global financial hub.
Yeah.
They can't just be sitting on the sidelines watching this happen.
They aren't sitting on the sidelines, but they are dealing with some serious internal friction. So on June 2nd, 2026, a House of Lords committee essentially pleaded with the Bank of England to relax its strict regulations on digital currencies.
Wait, why would they beg for relaxed rules? Usually governments want more control over money, not less.
Because of the underlying mechanics of how these networks actually grow. Stablecoins require massive liquidity and absolute ease of use to function properly.
Right.
If a government implements regulations that are so tight that it becomes incredibly expensive and legally burdensome to issue or trade a British pound stablecoin, well, innovators just won't bother.
Just go somewhere else.
Right, they will just build on top of the US dollar network instead. So the House of Lords is recognizing that over-regulation will simply kill the digital pound in its crib, basically handing a total victory to the dollar.
That makes total sense.
And we are seeing a similar urgency in Canada, too. They're accelerating their own regulatory framework targeted for late 2027.
You know what it feels like? It feels like a modern-day space race.
Yeah, that's a good way to look at it.
But instead of racing to put a flag on the moon, these countries are racing to get their national currency onto your smartphone before the US dollar occupies all the digital storage space.
Precisely.
So, if the rest of the world is desperately trying to fortify their borders, how is the US reacting to all this? Are American companies pushing back?
Ooh, American companies are leaning in aggressively. They're pushing this digital dollar deeper into the fabric of everyday traditional finance.
How so?
The data highlights a couple of monumental shifts in corporate strategy. Back in 2025, Circle, which is the company that issues the USDC stablecoin, they went public with an IPO.
Right, taking it mainstream.
But the really fascinating move came in 2026 from MoneyGram.
MoneyGram, like
Yeah.
the traditional wire transfer company you see in grocery stores and pharmacies.
Yes, that exact company. They launched their own dollar stablecoin called MGUSD. They are aiming to give their 60 million global users a way to hold and transfer digital dollars directly.
I mean, that is a massive paradigm shift.
Yeah.
You literally have a legacy remittance company realizing that the old SWIFT system of correspondent banks is a dinosaur.
Yeah.
So they were basically ripping out their old traditional plumbing and replacing it with crypto pipes.
Exactly.
But here's what I find really compelling about all this. It's the sheer divide and how global central banks are interpreting this transition. Because we have three very different perspectives at the highest levels of global finance right now.
The philosophical split is striking. As we discussed, Europe, represented by the ECB's Isabel Schnabel, they view the expansion of the digital dollar as an invasion. It is a direct threat to their monetary sovereignty that has to be countered with their own digital euro.
Right. Build the wall, keep the digital dollar out.
Then you have the UK perspective, articulated by Megan Green at the Bank of England. She believes the current panic over these independent stablecoin companies might actually be overblown.
Oh, really?
Yeah, she predicts the hype will fade in about 5 years, and they will be replaced by something called tokenized deposits.
Okay, let's unpack that term, tokenized deposits, because that sounds like some heavy financial jargon. For a beginner listening right now, how does a tokenized deposit actually differ mechanically from a stablecoin like USDC?
Mechanically, it is a crucial distinction. Let's look at a stablecoin like USDC first. It is issued by a private tech company on a public blockchain, like Ethereum. Anyone in the world can just download a wallet and hold it.
Super accessible.
Right. A tokenized deposit, on the other hand, is a traditional bank upgrading its own internal private ledger using blockchain technology. The money doesn't actually leave the banking system.
Oh, I see.
It's still your standard checking account at a legacy bank. But the bank has upgraded its back-end software so that your funds can move instantly, 24/7, using blockchain infrastructure.
Like upgrading the pipes inside your own house instead of moving to a totally new one.
Exactly. Megan Green is betting that legacy banks will eventually adopt this superior technology, which would make the tech company stablecoins unnecessary.
That makes a lot of sense. Don't count out the empire just because the tech startups have cool new software.
Yeah.
The banks have the capital to just copy the tech.
Exactly.
But then we get to the third perspective, which is the United States. Federal Reserve Governor Christopher Waller has viewed stablecoins incredibly positively. He's called them a major driver of financial innovation and payment efficiency.
And his perspective makes perfect sense when you step back and look at the underlying geopolitical advantage.
Absolutely it does.
Yeah.
And, we should contextualize this. The current U.S. president is Trump, and his administration's focus is heavily anchored on American economic dominance.
Right, the America First approach.
Exactly. And to be clear, we're not taking a political stance here, just reporting the context of how this aligns with U.S. policy. The Federal Reserve's positive stance is completely logical from a strategic standpoint.
Completely.
Because you have private tech companies building this ultra-efficient global infrastructure network, and they are using it to export the U.S. dollar to every corner of the earth. And the U.S. government doesn't have to spend a single dime to build it.
Nope.
Private companies are basically entrenching American monetary dominance for free.
It is a massive strategic windfall for the United States. But having explored this whole global chessboard, the defensive European alliances, the legacy bank upgrades, the aggressive U.S. corporate moves, how do we synthesize all this for the listener?
Right. If you're listening to this and trying to figure out where the global economy is heading or how to view your own investments,
Yeah.
it sounds like betting on which crypto coin has the coolest logo or the loudest marketing campaign is just the wrong move.
Totally the wrong move.
This is fundamentally a war over infrastructure. And based on all the analysis, there are a few core dynamics you need to understand to see the whole picture, right?
Right. There are about 5 key takeaways here. And the most profound dynamic is how this revolution fundamentally locks in dollar strength. And it happens through a very specific mechanical process.
Walk us through it.
When a user in Argentina or Turkey buys one digital dollar stablecoin, the company that issues that coin doesn't just put a physical dollar bill in a vault. By law, they have to back that digital token with a safe, liquid asset.
Let me jump in with an analogy here to make sure this mechanism is perfectly clear for everyone.
Please do.
It's basically like going to a massive casino and trading your physical cash for their plastic chips. You use those chips to play games, buy drinks, or trade with other players inside the casino.
Right.
But the casino doesn't just leave your cash sitting in a safe out back. They take your cash, loan it to the U.S. government by buying a treasury bill, and they pocket the interest from that loan. The chips are the stablecoins. The loan is the treasury bill.
That is precisely how it works. A short-term treasury bill might pay out 4 or 5% interest. When you have stablecoin companies sitting on over $100 billion in deposits, that interest generates massive, massive revenue. That is literally their entire business model.
And in doing so, these tech companies become giant vacuum cleaners, sucking up U.S. government debt. They are creating a massive, captive buyer for U.S. treasuries, which directly finances the United States government.
Yep. Which leads directly into the second takeaway, which is interest rate sensitivity. Because these stablecoin companies generate their profit from the yield on those short-term treasury bills, their entire valuation is tethered to the Federal Reserve.
Meaning they're highly sensitive to what the Fed does.
Exactly. If the central bank decides to cut interest rates significantly to stimulate the economy, the yield on those T-bills drops. And the profit margins of these massive stablecoin issuers evaporate almost overnight. They are highly sensitive to the macroeconomic environment.
So if you are looking at companies in this space, you have to watch the Federal Reserve's interest rate decisions like a hawk.
Right.
They aren't immune to traditional finance. They are entirely dependent on it.
Exactly. Now, the third takeaway is the bank defense strategy, which we discussed with Qivalis. When you see European bank stocks or any major global bank investing heavily in blockchain initiatives, it is crucial not to view this as speculative risk-taking. They are not gambling in the crypto casino.
It's an existential defense.
Yes. They are protecting their future fee revenues and their access to cheap customer deposits. If they fail to provide instantaneous blockchain-based settlement, institutional money will just migrate to platforms that do.
Right, which ties into the fourth point, tokenized deposits.
Exactly. Upgrading to tokenized deposits is simply about legacy banks maintaining their core business model in the 21st century. Watch the big banks upgrading their own private ledgers.
Got it. And the fifth takeaway.
That brings us to a fascinating double-edged sword, the impact on emerging markets. On an individual level, this technology is a financial miracle. It provides everyday citizens with a shield against local hyperinflation and a way to bypass predatory remittance fees. It empowers the individual.
Which is an amazing thing for people living in unstable economies.
It is. But the flip side of that empowerment is macroeconomic instability. If a significant portion of a country's population abandons a local currency in favor of digital dollars on their smartphones, the local central bank is totally neutered.
Wow, yeah.
They lose the ability to manage crises, stimulate growth, or control capital flight. The technology saves the citizen while simultaneously wrecking the state's ability to govern its own economy.
So the ultimate takeaway here is to watch the plumbing. Watch who owns the payment applications that people are actually downloading to their phones. Watch the massive tech companies that are holding the billions in U.S. treasuries backing these tokens. And watch the legacy banks as they attempt to upgrade their own private ledgers to compete. Whether it's traditional financial titans or scrappy new tech conglomerates, the entity that controls the physical and digital pipes that the money flows through will dictate the future of global finance.
And when you look at those pipes, it leaves us with a rather profound, almost unsettling question to ponder as this quiet war continues.
What's that?
Well, we've examined how this infrastructure spreads the U.S. dollar globally. But if billions of people across South America, Asia, and Europe are relying on digital U.S. dollars held on smartphones, does the U.S. Federal Reserve essentially become the central bank for the entire planet?
Oh, wow.
And perhaps more critically, if the backbone of global daily commerce runs on a digital dollar network controlled by U.S. entities, what happens to the rest of the world if the United States ever decides to freeze that network?
Wow. An invisible digital empire run from a smartphone with the power to simply turn off the tap. Now that is a thought to chew on. Don't forget to subscribe and hit that like button.